Companies exposed to property or construction that are still standing post-GFC are starting to see some light at the end of the tunnel. Australia's biggest building products company, Boral, with exposure in the US, is now talking about acquisition and expansion after profits went up by a third. One of the country's largest property trusts, Stockland, has also had a better story to tell. Here's Philip Lasker.
Those that survived the turbulent real estate and construction markets during the global financial crisis are beginning to reap the rewards of a return to some sort of normality.
The things that we've done to improve our productivity, to improve our marketing, and develop more robust businesses are starting to show through in the results.
Building products maker Boral posted a half-year profit of more than $92 million, up 36%. It also raised its interim dividend to 7.5 cents a share from 7 cents and forecast a full-year net profit of at least $160 million, up 20% on the previous year's result. After years of going backwards, Boral raised money to reduce debt and lower interest payments, which helped the bottom line. Operational improvements also helped.
All of our divisions across the group made margin improvements during the first half, except for construction materials.
But investors want more.
I'm looking for them to improve margins back towards the levels that we've seen prior to the financial crisis. And it won't be easy, but there's significant upside if they can, because profits are currently around 60% below what they were at their peak.
You're not going to see massive movements period to period, but progressively I expect we will continue to see improvements in margin performance year on year on year out of all of my divisions.
Acquisitions are on the cards as well, particularly in Queensland, Western Australia and the United States, where Mark Selway sees tremendous upside.
It's currently 560,000 housing starts versus a 50-year average of 1.5 million. If that was turned to the positive, it would have a dramatic effect on the earnings of the group.
Australia's second biggest property trust was also on the up, thanks mainly to one factor:
our ability to really outperform in the residential community space.
Stockland's share of the house and land market rose 6% to 30%. Income for the half year nearly doubled to over $425 million. The distribution was increased 9% to 11.8 cents a share, and earnings per share growth guidance was also upgraded from 7 to 8.5%.
The only dark clouds on the horizon for us really are if interest rates really do start to escalate and hit the hip pocket of the consumer and dampen down residential. But aside from that, I think we've got some very strong growth prospects in our business.
Like doubling its retirement community portfolio and an ageing population.